Hi, everybody. Thanks so much for joining.
So let's get started. Good afternoon. I'm Ethan Stein. I'm your host for today. I'm the Strategic Partnership Manager here at Escalon. Been at Escalon for a number of months now, since March. I'm an angel investor when I'm not working. I enjoy extreme athletic feats for charity. I just got back from Mount Kilimanjaro, so that's a bit about me. We are very excited for today's webinar. A few housekeeping notes before we get started. Our webinar will last about 60 minutes, including some time for Q&A at the end. Feel free to place your questions in the Q&A box at any time throughout today's webinar. And during that Q&A portion of the session, Michael and James will be able to answer those questions. This webinar will be recorded and sent to each of the registries within 48 hours after the presentation has concluded. And you'll be able to find this recording and many of our other Meet the VC webinars on our YouTube channel, which will be sent in that post-event email as well. A bit about Escalon. Escalon, together with our acquired companies, Early Growth and Full Stack Finance, is the one-and-done solution for all essential business services, including FinOps, CFO services, bookkeeping, accounting, tax, and the like, people ops, human resources, benefits, recruiting, payroll, and risk, insurance, business insurance, and medical insurance. Since 2006, we've helped over 5,000 companies across a range of industries. Our strategic advice, mission services, finance, and people-related matters enable us to escort early-stage companies throughout transformation into large enterprises or successful exits. Both Escalon and our CFOs have been around the block a few times. We've helped and served over 5,000 clients. Many of these names hopefully you recognize from coast to coast and around the world. As always, our CFOs have helped clients raise billions of dollars, and we'd love to help and serve as well. Why Escalon? Why us? We believe in delivering peace of mind by providing you a one-on-one solution for all your needs and requirements, including CFO services, HR, accounting, taxes, and insurance. We like to protect your profitability by getting the sole point of contact to answer all kinds of questions, as well as strategic dashboards to help understand your business better. We want to be your partner in growth. And by us working on your back end and focusing on that, you're enabled to focus on the continued growth of your business. That's a perfect synergy. As the summer comes to a close, which means the year is coming to a close, you want to get a head start on effective tax planning for the year ends. So a special promotion for all of you joining our webinar today, $500 off your 2023 tax preparation. Shoot us an email or reply to the email at the end of the webinar, and we'd love to help you get squared away. We are very excited and fortunate to have Michael Carlino, a colleague of mine, be our presenter today. He's been in Escalon for quite some time, coming up in 5 years in multiple business development roles. Prior to joining Escalon, Michael owned and operated his own small businesses in the quick service food industry. And in his spare time, Michael enjoys playing golf and traveling. Most recently, he's been to Ireland and to Hawaii.
Thanks so much, Ethan. Nice to meet everybody. Thanks so much for spending some time with us today. We really appreciate it. Hopefully my audio is a little bit better. Please shoot me a message in the chat if you're having any difficulty hearing me, and we'll see what we can do. But before I get into the interview with our guest today, James Murphy, I want to introduce our partners and give them an opportunity to introduce themselves and their company. So we'll start with Jose Rivera, Special Counsel at Gunderson Dettmer. Jose.
Hi, everybody. I'm Jose Rivera. I'm counsel at Gunderson Dettmer. Gunderson Dettmer is the preeminent law firm exclusively focusing on the innovation economy. And what does that mean? It means that we serve as trusted advisors to pioneering private companies from inception through growth and maturity. And we also represent public companies that result from the venture global capital system. Whether you go an IPO or you end up selling an M&A event, we'll be there from birth all the way through the life cycle of a company as a right-hand advisor. We also advise market-leading venture capital and growth equity investors in fund formation, investments in their portfolio companies, and in reviewing those portfolio companies' eventual exits or IPO events. We're a business-focused law firm. We provide practical advice to our clients and focus on creating pragmatic solutions to what are often complex legal problems that are confronted in the startup ecosystem. Our single-minded focus in the VC market really allows us to solve problems in a more efficient manner with better outcomes, given that, you know, we're repeat players in this business, as well as having strong and deep relationships with everybody that operates within the VC ecosystem. Like you all, I'm super excited to learn from James today, and I won't take up anybody's time anymore, and I'll kick it back over to everyone else. Thanks so much.
Thank you, Jose. Next up, we have Ian Garrett, who's a business development manager at Capchase. Ian?
Thanks for the intro, Michael. My name is Ian Garrett. I'm a business development manager at Capchase, working with our investor partners. Here at Capchase, we provide non-dilutive funding to SaaS companies or other recurring revenue businesses. We extend a revolving credit facility in the range of 20 to 60% of ARR to help fund growth initiatives and extend cash runway. We work with companies all the way from 150K ARR and up, and to date have extended over $2 billion in financing to several thousand startups. Really excited to learn from James today, and I'm very honored to be here.
Thank you, Ian. Last but certainly not least, we have James MacArthur, Director of RevOps at New. James?
Well, thank you, Michael. Great to meet everyone. My name is James MacArthur. I am the head of RevOps partnerships and community here at New. New is the next generation quoting and billing platform for Salesforce. You can think of us as a full revenue lifecycle engine. Some ways that we're changing the game when it comes to CPQ and billing is really around making things faster to implement, really, really high speed to value, really easy to use, built for modern business models. So giving you the ability to really conquer, land, and expand, own both usage and consumption models while making the entire journey from subscription management a heck of a lot easier, all in a package that can be implemented in about 4 to 6 weeks. And designed for the future of your business. So with real-time visibility in your ARR, usage, and the entire insight suite built into the package. So excited to talk to y'all.
Thank you so much, James. All right, now moving into the main event. Today we have as our guest James Murphy from Forum Venture Capital here in New York City. James is a general partner at Forum. Before that, he was a co-founder at a company named Robly, MarTech automation platform. He's an active angel investor and advisor to numerous SaaS-based startups. Before his time at Robly, James was a VP at Barclays Capital. And he's also an alum of Villanova University. Go Wildcats. Before we get into the interview, I just want to make a note. If you have any questions for James, please drop them in the chat box. You can either send them directly to the host and panelists, or you can send them out for everybody to see, whatever you prefer. And we're going to definitely be reserving some time, 10 to 15 minutes at the end of the conversation to make sure any questions that you have for James are asked. So we'll try to be as efficient and forthcoming with our interview as possible. We definitely want to leave some time at the back end for any of the audience's questions. All right. On that note, James, thanks so much for allowing us to pick your brain for the next half hour. So we're all really excited to hear your perspective on venture capital, specifically the B2B SaaS space where Forum focuses, and its ever-changing present and future. I guess to kick off, please tell us a little bit more about yourself, Forum VC, and the current state of affairs today at Forum.
Sure. Thanks, Michael. Before we get started, I just want to make sure that my audio is good. I can put up my headphones. Okay, everybody hears me good? Great. So I'll give my brief background, and then I'll weave that into Forum and what we do. And then, I'm happy to kind of share some insights and color that I have on the market, just because there has been such a shift over the last year plus in terms of the funding environment. And I think founders don't always have the cleanest line of sight into that. So hopefully I can help with some of that. But just briefly on me, I started my career actually outside of tech. I graduated school in 2004, and on the East Coast, a lot of people went to work on Wall Street. That's what I did at the time. So I landed at one of the big banks, Barclays Capital. I was a credit derivatives and structured products trader. I was there for about 8 years. traded like a $24 billion book through the '08 housing crisis. Really interesting, really analytical. I loved it. But those were long days there, long years. And I hit a point about 29, 30. I was like, you know what, am I going to do this the rest of my career, or am I going to try something different? And that different thing I tried was I launched a SaaS business with one of my trading partners and his older brother and best friend who had ties into Stanford, into Silicon Valley. We scaled that business over a 7-year period to 50 employees, 30,000 users. It was a marketing automation platform. As you mentioned earlier, it was called Robly. We sold that in a 8-figure exit to what amounted to an entity that was doing a roll-up strategy in a traditional private equity type structure. I stepped back from day to day in the business about 2 years before we sold it. We knew where the business was headed. We were getting ready to sell it. And frankly, the dynamics of 50 people in a room are much different than my co-founder and I when we first launched the business. And frankly, that was the part that I found to be really fun. So I wanted to make my way back towards investing. So I started angel investing. I was mentoring at a few of the accelerators in New York City. And as part of that, I was fortunate enough to meet my now partner at Forum. We were called Accelerator at the time. But I was doing some mentoring there across the cohorts of companies coming through. And yeah, I joined the team. I've been here for approaching 5 years now. Forum to date has funded almost 400 companies now. I've been around for close to 200 of those. Our strategy is three-pronged from a fund structure, if you will. We run an accelerator. We've been doing that since 2014. We will fund between 90 and 100 companies out of that accelerator this year. We also have a seed fund where we invest in pre-seed and seed rounds. We will lead pre-seed rounds. Depending on the size of the seed round, that can mean different things to different folks, but we can either lead or be the second largest check in a seed round. And we also have a studio, which we can chat about later if it's of interest to folks. We'll launch about 8 to 10 companies a year out of that. And those are companies that we ideate internally, then recruit in teams and launch them out into market.
Excellent. Thanks so much. Fantastic overview. And as you mentioned, there have been significant shifts in our little slice of the market over the last couple of years in this SaaS space. First, the COVID shutdown, then the post-acute COVID explosion, and most recently, a reset or regression, depending on how you look at it. How has Forum navigated these ebbs and flows, and how have they affected, if so, your appetite for today's investment opportunities?
Yeah, I alluded to it earlier, but the market went through a systemic shock in March, we'll call it, of 22. The signs were there for a while. People have been calling for the bubble, but they're very hard to time bubbles. And I've seen a few of them now in my career, whether it was credit derivatives, the housing market, now the tech cycle here. But in about November of 21, we started to see the public markets pull back. About 4 months later, the memo was down to VC investors, and we saw a dramatic pullback in funding. And what VCs did in that moment was a classic flight to quality. They focused on sectors they knew really well, as opposed to fringe ones that were maybe a little more FOMO around, but maybe they didn't have core expertise in there. Whether that would be Web3 or investing with a skew more internationally or things to that nature. I think a lot of VCs went back to tried and true industries that they knew well and thought they fundamentally had an advantage in. They looked towards repeat founders and oftentimes portfolio founders that they had funded in the past of ones that they then wanted to fund. And, as part of that, I'll speak first to how this affected the funds and then later how it affected founders. And then also like how we as a fund reacted. But, the bar to raise capital from a fund's perspective was raised much higher. There's less appetite now to do pre-revenue idea stage companies We were seeing a lot of that get done. And that was a pretty stark reversal there early in terms of that no longer being something that teams were like super keen on looking at it from that perspective. And then the last thing that was really affecting the funds was just from an LP perspective, because founders don't always think about that, but that drives a lot of the decisioning there. The reality is, many VCs now will not be able to raise follow-on funds. There was a saturation in the market because of the run-up, the 12-year bull market, if you will, brought upon by the zero interest rate environment. And many funds will not be able to raise follow-on funds. Many LPs are over their skis right now in terms of their allocation into venture. You tend to invest more into an up market. So a lot of the amount of capital that LPs invested scaled into the height of the bull market. And now they're sitting on portfolios that they're frankly a little wary of. And what this means is VCs don't necessarily want to go out to market right now to raise another fund because they know LPs are still trying to figure out allocations across their own portfolios. And what that means is at the height, funds are getting deployed over a year period, right? In the 21 vintage, the 20 vintage. Now VCs are trying to stretch that out over 2 to 3 years to give a more traditional basket of diversity from a time perspective across those funds. So what that means is they're not writing as many checks as just less volume of deals getting done. So that's from a funds perspective. And what does that mean from like a founder? So if we're in this flight to quality environment, like founders just need to show that much more to the market. And I sympathize with founders right now because they're asking to do so much more with so little still. And we see that a lot at the Accelerator, but we were at a period in 20 and 21 where a big market, a good founder, and a good vision could usually find some pocket of institutional capital to fund it. And now that has changed to where you have to somehow launch a product into the market and actually have some sense of traction around it in order to bring institutional capital. And that's a dramatic change. And I think that's been a hard one for founders to realize. Valuations have come down a lot. So in 21 and 22, you were seeing a lot of pre-revenue startups get funded. You see these rounds like $5 million at a $25 million post-money valuation. Like that isn't happening anymore. Sans a few hot areas, if we'll call that generative right now, we'll still have some bit of FOMO around it at these early stages. But for the most part, we're seeing pre-seed rounds get done now with usually some revenue around them in the $5 to $8 million cap ranges, and seed rounds get done in like the $10 to $20 million range. And that's a big change, right? And I think there was a delay for founders of understanding that. I think now it's been long enough that we're starting to see an understanding there from founders. And the other thing I think is worth noting, because I have a lot of conversations across our portfolio, this idea that this is somehow a passing fad or a simple bump of the road. I'm not of that belief. We were in an environment with zero interest rates for a long time. That is not coming back anytime soon. The risk-free rate will be plus or minus about 5% going forward for the foreseeable future, in my opinion. The reason for that is there are systemic inflationary pressures that now permeate through our economy. Part of that is an effort to nearshore, so we're not so reliant on supply chains in other countries. We saw the impact of the China shutdown on our borders. There's also a push for energy independence and more green energy sources. That costs money to do that, inherently a higher cost of energy that we need. And then also there's just been demographic shifts around labor participation. Some of that is the boomers aging. Some of that is early retirement from COVID within that population set. But we're at historically low labor participation rates. These are just like things that are going to lead the economy in a position where we're just in higher interest rate environments. So I say that all to say that the days of 2021, from my perspective, are not coming back. And that's fine. I think it's still a great environment to be funding, which gets me back to the forum perspective of how we've reacted. So we're leaning in here. We're funding more companies this year than we've done in the past. Like I said, we're doing 100 companies. We think there's been a pullback from many VCs. We think there has been an exodus of many angels and many rolling funds that had been prolific in the market for a while. And we also think this is a great time to be launching a company. Historically, this is when some of the greatest companies have been formed. Part of that is from a pure investing perspective, we as investors are able to enter in at a lower valuation, but also the companies that get launched right now, they're born in the fire, so to speak. There's a necessity and a different grit that comes out of that to be able to launch a business at this time, and it makes them more viable kind of going forward. So anyway, that's kind of how it's surmised from a fund perspective, broadly speaking, from a founder's perspective, and also just kind of how we've reacted to this pullback. I'm sure there'll be a couple of questions later around a lot of that, because I feel like that's a lot of the stuff founders ask me about. But I'll pause there.
Yeah, no, thanks. That was a fantastic answer. Just a really quick follow-up on that. Since fewer checks are being written overall, does that have an impact on how many new companies are starting? Are there the same amount of founders with these opportunities being brought to you as in 2021, or are there less to choose from nowadays because founders know it's likely going to be bootstrapping, or they're going to have a really tough competitive environment to secure funding?
Great question. I don't have tangible data there outside of stuff we
Anecdotally, yeah.
Anecdotally, there's an interesting dynamic. I think maybe there's a slight decrease in the amount of companies being formed. Sorry if there's a barking dog in the background. I think probably there's a slight decrease in the amount of companies being formed, but there's a really interesting dynamic where there is a logjam of companies at seed. So not only right now, if you're going after the market to raise capital, you're raising money and competing against every pre-seed and seed company that launched in the last 6 to 9 months. But you're also competing with a lot of companies that raised a bit of capital, are trying to do now a seed extension or pre-seed extension. They have some revenue, but maybe they're not in a position where their existing investors want to fund them. So there's a logjam there. So whether or not more companies are being started right now, I don't have tangible data. I'd say slight decrease, but not much. Still great time to launch a company. But there are more companies right now trying to get seed rounds done with actual traction than there have ever been since I've been in the seed. And that's because of that dynamic of just some companies that are now coming back to the well again to try to raise like pre-seed extensions, seed extensions, et cetera.
Got it. Understood. Thanks. You mentioned before when you were giving the intro about the 3-pronged approach that Forum has. Let's start with the Accelerator program. Tell us a little bit more about that and share maybe how hands-on Forum is while developing the startups within the Accelerator, and maybe a success story of a company that joined up and has gone to greater heights.
Yeah. So I think it's part of the reason why we've leaned in this environment is because of what I said earlier, where the requirement to show to the market from a progress and traction perspective is much higher now, but founders aren't being given more resources. So they basically have to hack it together, so to speak, to get into the market to raise institutional capital. And I think the Accelerator model is really helpful around that. So, in the past, it was compelling narrative. You could raise capital, right? Now you actually have to show progress around having some structure and proof points around a go-to-market motion. And that's where the magic in startup world is. It's not the idea. It's not being a great pitcher, although for 19, 20, and 21, you were certainly rewarded for that. But the magic is actually getting a product into market that people want and eventually finding the elusive product market fit. Like that is what startup world's about. And I think that is paramount right now. And there was a period in 20 and 21 to raise a seed round, you didn't really even have to consider that as much, right? You could just have a narrative. So what we focus on at Forum is go-to-market strategy, standing up an initial sales process, and then yes, eventually fundraising, but in that order, right? We're very hands-on. Part of that is just the way we're structured. So we have dedicated MDs that work with batches of 10 companies at a time. It's not like a traditional accelerator where there's a 3-month sprint and then there's a demo day at the end. It's very curated. We try to figure out the types of businesses, what needs to be true to raise institutional capital, and then what is a realistic timeframe of getting there. And we have some businesses that come in and we say, we need to do X, Y, and Z. We think that can be achieved in a 2 to 3 month period. We'll go out to raise capital. There's others who are this can take 9 months, and that's fine. And we're set up to support throughout that. So we're doing anything from reviewing sales pipelines to reviewing outreach copy making intros to customers, helping with initial recruiting, getting the weekend texts, all of that. I mean, I think a lot of there's a lot of founders on this call now. So they're through the stage of bliss, so to speak. And you realize very quickly, being a startup founder, of just how brutal an existence it is. And it's beautiful. Like it's great, but it's also it's so hard, right? And I think that's something that I know from my experience of launching Robly, all my senior partners here and MDs, we've all been founders. There's a big part of just understanding that the founder journey is not sexy. It's really hard. I always say to founders, be prepared with this. Your worst day as a founder is undoubtedly ahead of you. And you need to be able to react and pivot off of that, because that's what this is all about. It's having the grit to kind of go through that. And on this accelerator level, and this gets resonated so many times that I talk to the companies you work with, simply having somebody in your corner that has a vested interest and truly cares what you're building from just a psychological perspective is so helpful. So that's a big part of it. And that's I remember when SVB went down, I was on the phone all weekend with founders. One of the founders was in India getting married, and I was giving them updates over text, being I think you're going to be okay. Here's the recovery rate, I think, of the deposits. She had $2 million sitting in SVB. That level of support, it's been said back to me as a fractional co-founder, the way they think about it. We are a team of 28, which is super unique at this stage. And that's just a lot of support and resources across the team. We have a large platform team. Looks a lot like a platform team you'd expect to see at a Series A or Series B shop. We do that here at the area. And then last thing on the accelerator is just network. That's some of the biggest unlock you can have as a founder. Some are blessed with it already through either work experience or other areas they've been able to accumulate it. But for the vast majority of founders, they don't have that. And I view an accelerator as a hack through to that. We have 400 startups we founded. That's 800 founders. We've co-invested with 500 funds. We have mentors, LPs, advisors that help around the portfolio. Those are all nodes that we can introduce our portfolio founders to, which time and time again yield great results.
Got it. Yeah. My next question was going to be about that decision that founders go through of, do I do this on my own because I'm a founder? I believe in myself. I believe in my company. Do I do this on my own, or do I give up a little slice and join an accelerator? I think the example about SVB was a fantastic one, because that just shows the value that a partner like you and a fractional co-founder, the way you framed it, can add value with. Can you touch on that a little bit more? Share some thoughts about
I don't take it lightly.
The founder has to make.
Yeah, I don't take it lightly, nor does anyone else on our team. I think there's the reality that there's no qualification or test or regulatory hurdle you have to clear to open up an accelerator, right? And to the outside observer, the model is great, but to deliver a really good experience is hard. That's why you see a lot of churn from accelerators. So we are not the cheapest source of capital. I say that to founders all the time when I talk to them. I also say that we realize that we have an accountability to you as a founder to make sure that we are driving commensurate value for that. The reality is, and I can say this for myself, but I think I speak for the whole team here, is if I thought we were in a position where we were not delivering upon the value of the accelerator, as I think many early stage investors or things like that, I do something else. I just would. It's not the game I would be in. And I always ask founders after we've worked together. In some cases, this is after they've closed A's and B's. It's also sometimes after the company has failed. I'm like, would you do this again? Knowing now everything, would you do it again? And almost uniformly, it's been a resounding yes, which gave me a lot of confidence. When I first decided I was going to join Accelerator at the time, now Forum, and work with companies in this capacity, I said to myself, if I don't feel after a year that I'm living up to my end of the bargain here and making a meaningful difference in the companies, I'll stop. And that just hasn't been the case, and it's been good to see. But it's something I like founders to go into with open eyes. I encourage them to talk to other founders. Encourage them to talk to other founders where things haven't worked out and the support they've been able to get there. Yeah.
Got it. Thank you. Very compelling indeed. You also offer the venture studio as one of the other two prongs. Can you touch on that, how that's different from the accelerator and what value that can add to founders?
Yes, so studio is really interesting. We do ideation, and we validate internally. We have a team of about 10. We validate internally, we line up early customers, and then we either recruit in from existing network or other nodes, CEOs to come in and launch those companies. I think a lot of what we've built here across our team of 28 is an engine to help companies, once there is a viable business concept and desire to launch it, to really figure out go-to-market, sales, and then fundraising. So I just view if the studio is the 0 to 1 moment, where it's like, okay, we have the idea, we have the concept, we have the team, we're going to get a product to market, we're going to get some traction, go to the seed round. I view the studio as, like, if you will, the -1 to 0, where it's that stage before ideation. But once we get the ideation and the student and the founder in place, it looks and feels very much like an accelerator company, kind of along this journey. So it's studio is this early stages, then the accelerator, and the seed fund is just simply those companies that have moved forward through proving out go-to-market and sales, and are going to raise pockets of institutional capital.
Thank you. And shifting focus to the last prong, the seed fund, pre-seed fund. Are there common characteristics of an exceptional startup or portfolio company that distinguish it from the rest of the businesses that you're constantly evaluating? I think, the founders on this call and myself, would really like to know what separates that 1% from everybody else. Is it the founder themselves? Is it the product? Is it a mix of everything? Share your thoughts, please.
Yeah. So I would attribute a heavy weighting, particularly at the earliest stages, which is accelerator, pre-seed, and seed fund, on the founder and their market fit. So, you're facing impossible odds as a startup founder. Like that's the reality. Like, we all know the stats, right? And there's a level of, like, passion, grit, intensity, drive that just needs to be there from a founder. Because as I said earlier, like, you inevitably will get knocked down, and it will be hard. You just have to get back up, and, like, that is not for the faint of heart. So we look for demonstrations of, like, past endeavors where they've been excellent, past endeavors where they've persevered against odds, did something that is most people look at and say that's impossible to do. We don't care about pedigree. Like, don't care what you look like, don't care where you went to school, don't care where you worked at. I care more about what you've done in life, what life experiences you have, what unique aspects of you as an individual lead you to this moment in time and this problem and this solution. So lived experiences, if that makes sense. And I think also these are more just like characteristics, but I find them almost consistently across all of the successful founders I know. They're just great communicators. They tend to be able to inspire people, hyper organized, right? They're the ones, I'm not, their follow-up is phenomenal. There's an obsession to the business. And I know there's a lot of back and forth around that right now, just in terms of work-life balance, things like that. I think to do the impossible, to launch a business from nothing that ultimately is a public company that has tens of thousands of people who work at it, there's an element of obsession that just needs to be there. And if not, it's too competitive. It just really is. So just that unbelievable drive there. So that's on the founder side. And the market side is, like, so hard to encapsulate, speaking broadly, just because there is so much nuance to all of it. But I look for trends, like what is recently changed, like why is now the time to build, what gives this team a unique advantage, all those types. And I know that's really high level, and I know we're not here indefinitely today talk about that. It's much easier to talk about specific business, but those type things are we look at. But a lot of weighting towards the founder, because the businesses will change, markets evolve, great people don't. And that's kind of what you really try to find in these earliest stages. Got it.
So would you say, being at the pre-seed seed stage, would you, 50-50, 70-30 of subjective instinctual belief in the founder and company compared to criteria and stats and data when you're making that decision?
So at Series A, Series B, I would get to put my old Wall Street hat on,
Right.
dust off the financial model, and really just be very analytical. The reality is you don't get that opportunity at these earliest stages. So for better or worse, there's a lot of network, diligencing, validation, understanding customer discovery, like that kind of stuff. Seeing trends, understanding pattern matching across other industries, other types of startups, but much more qualitative than quantitative there. And that's just the reality. That's why seed shade investing is fun. It's also why it's so challenging. But we try to do our best of, if we are not an expert in an area, leveraging the community, the team, to diligence, better understand, talking to customers, really understanding the problem and solution sets. But no, like CAC and LTV and all that stuff is a pipe dream at the stage that we're investing. Usually, it's more about trying to see trends and read people and things like that.
Understood. Thanks so much. And I'm sure the questions coming in from the chat are going to have a lot more to do with the fund and maybe your thought process and criteria around evaluating businesses. So we're going to pivot to some higher level market-based questions. And then once the Q&A gets going, I'm sure we'll move back into the forum side of things.
Cool.
I have to bring it up. Everyone's talking about AI. Every panel or webinar I listen to at some point or another touches on AI and the effect it'll have on technology companies and the world as a whole. Can you share your opinion with us regarding the impact of AI, specifically generative? I know you mentioned that before. And what do you think the impact will be on the startup world? Do you trust your portfolio companies, front or back ends with integrated AI software? Just your thoughts on the topic as a whole.
Yeah, it's an exciting time to be alive, so to speak. That's something my dad used to always say to me across different aspects, right? I don't think we've ever seen a technological shift, an advancement this dramatic that has been democratized at scale, almost at the same time for everyone. And that's created a very interesting dynamic. So the utility of what's being created right now, particularly across like the application layer. And when I say that, I mean like whether it's image models, writing models, chatbots for computer support, or customer support. The utility of that is just undeniable. It's amazing, right? And the growth off of many of those companies is unprecedented. So you have this dynamic where it looks and feels like product market fit, right? I would contend, though, the barriers to entry for many of these horizontal application layers is super low, right? Because a lot of the technology, these first versions of writing models or image writing models, I'll say, or chatbot models, is commoditized to a certain extent. And I think that produces a real head fake for venture investors. Because if you looked at it simply through the lens of the growth, right, and the virality of what was being grown, you'd be like, wow, that's a generational company right there. I would contend that there is going to be a lot of stall outs in some of these horizontal layers. And that's not to say, so that's the somewhat bearish take on some of this. The bullish take is where I think there's interesting opportunity here as a fund. First area is more so around the infrastructure layer, more so around the tooling to allow this reimagination of software solutions across the enterprise, right? And examples of that, we have a studio company that we've launched, which is essentially allowing enterprises to leverage third-party LLMs, right? And I know this from being at Barclays, but this is true of being in any enterprise. They're not in a position right now where they're just going to allow their employees to start uploading proprietary data into open models. They're just not. But giving them the the compliance and regulatory oversight, the authorization, the anonymization of data to leverage models, third-party models for certain workflows. I think that layer is really interesting, right? And that's a company we've launched there. I'm also of the belief that almost every enterprise and many companies will have their own proprietary LLMs that they train on their own data sets that they use and tweak for their own intended purposes. So while I think like generic third-party writing models, things like that, you're not going to build that internally. You have core models that you build for your own underlying businesses. But in order to do that, there's a layer of infrastructure. There's another studio company we've launched that is to be in place to structure, to train, to maintain these models, right? And I think those are the type of opportunities that we think are more interesting than these horizontal applications. Now, the other area which we think is interesting is we'll call it like vertical AI. So that is a case where, you know, if you look at like the evolution of vertical SaaS, right, or SaaS in general, like the first layer was bringing it from on-prem into the cloud, right? And that takes us from basically my early days coming out of undergrad in 2004 through when I first got into like, you know, starting my startup in like 2011, right? And the next stage, like vertical SaaS, is okay, like let's layer in and let's expand out the ACV of our customers. So let's layer in embedded fintech, whether that's payroll, whether that's lending, right? We said everything becomes a fintech, that adage we've all heard. And then also layer in like marketplaces, say. But now this next leg will be like, what do hyper verticalized, nuanced models for certain verticals look like? And will a horizontal solution be able to deliver the solution that's necessary there? And we're of the belief that there is a massive opportunity here to have that hyper verticalized, highly specialized model that will have a source of proprietary data that will be in a position to be a wedge into a certain vertical that ultimately could displace legacy software that's there right now. And look, there's the case to be made for, well, are the incumbents in a position to do that already? Sure, there's two sides of the coin here. But we think, generally speaking, that that's an area that we're really leaning in on. And just slight examples of that, if we were to take the example of, take even the writing models, right? This idea of a hyper-verticalized writing model that was trained on legal writing or clinician writing in a healthcare setting, or research or regulatory work, things like that, or specific customer support bots or sales bots that were trained on nuanced industries that are fairly analog, right? That a horizontal solution wouldn't be able to give in. Like those are very interesting niches to kind of start as your expansion into there. So anyway, we could go on a lot for around kind of AI and things like that. And we see a lot of stuff. We look at a lot of stuff. We've been investing in a lot of AI. That's not to say we haven't done a few horizontal AI applications, but as the dust has settled, as we've really started to sink our teeth in here, those are kind of the areas we're focusing in a little more here.
Yeah. There's about 10 more follow-up questions I could easily ask you right now, but I'll spare the audience because I know I want to get to your Q&A and we're coming up on it. So I'll ask my last question and really try to bring it around to where we started. I hosted one of these panels about 12 months ago. At that time, the average early stage pre-money valuation had doubled in the prior 12 or 18 months, and late stage valuations went up 4x. And we discussed at that time if we felt that we were entering a bubble or if we were already in a bubble. And the consensus was, seems like it, will wait and see. And now that the dust has settled, the bubble popped. I will ask you for a prediction of 12 months from now. Where do you think we are? Do you think valuations, as you mentioned before, we're never going to get back to the 19, 20, 21 days, but do you think we're going to be in the same spot we are now as far as valuations go? Or do you think it's going to go up, go down? Just what are your thoughts on what the next year looks like for founders and the entire market as a whole?
Yeah, that's a good one. I would say in 12 months, I think the market will look a lot like it does right now, with hopefully a little bit more velocity in the volume of deals getting done. And the reason for that is the thing that scares an institutional allocator, an LP, the most is I shouldn't say the most, but a concern for them is an inability to run what a discount rate should look like across an investment. And when you don't know what the risk-free rate is going to be, and it used to be 0, and it's getting raised a 0.5 point at every Fed meeting, you don't know if it's going to stop at 5, 6, 7, 8, 9%. And until you know that, it's really hard to make allocation decisions. So I think we're seeing some stability now, right? And look, the NASDAQ has traded well, but it's really digging. It's across like 7 or 8 names, right? But there's been it's the same thing as when you jump in a cold pool. It's not cold after a few minutes. You get used to it, even though it's still cold. And I think the market's kind of in that stage. So I think LPs will kind of come back through, and we're already seeing it. And I think that'll be a byproduct then of more VCs kind of putting velocity into the market from a deals perspective. But from a valuation perspective, we have a long way to come back. So the 100 ARR, 100x ARR revenue deals that were getting done, that was because the public markets, the Bessemer Cloud Index, were trading like 25 times, right? That sounds like 8 times now. And you start to run the math, and this is just by my nature who I am as a ex-trader, right? The math looks really skewed still for entry points. And I get it from a venture perspective, like power law, the winners, right? And what that looks like. But as you think of broader portfolios and where valuations should be, I tend to think they'll stay here, if not come in even a little bit more, unless there is a change and I'm wrong and rates come back down and multiples come back up and things like that. But I think we're kind of adjusting into this new normal. You know, at the height, Airbnb, Snowflake, Coinbase, when they went public, I don't have the numbers in front of me, it's 60 billion to 100 billion they're going public at. Those are like crazy multiples, right? Whereas if we go back 10 years ago, companies going public, 6 billion, 7 billion, 8 billion was kind of their entry point in the markets. And when you run these 2 scenarios across early stage, you have to start to adjust through and see what it looks like. And I think it's taken some time. I think particularly at this early stage, many of those investors aren't as keen on, as focused on public markets. And I think eventually over time, everyone will catch up. So if the market stays where it is, I think valuations could come in a little bit. But by and large, I think in 12 months, the world probably looks very similar. I think the long tail, the less likely outcome is that we see something along the lines of a reimagination of the SPAC market and $1 million NFT avatars and 100x ARR valuations. I just think that was a byproduct of just a weird moment in history where we'll look back and say, wow, 0 interest rates. That was fun. That was interesting. But I think we've entered into a new paradigm, and these take cycles to kind of clear through.
Yeah, should be interesting how history books view that brief time, right? Well, James, thanks so much. I hope that was really enlightening for everybody in the audience. It sure was for me. Before we finish up, there's a few audience Q&As that I'd like to rapid fire with you since we have a few minutes left, and I'll just start from the earliest ones that were submitted to us on down. So we'll start with Hugh Brown. What does Forum Ventures consider as a large TAM, and what do you look for to lead around?
I'll try to go quick here. Large TAM north of 5 billion, ideally bottoms up, not just saying that $30 billion gets spent on software development as an example, right? So bottoms up, tying it to bodies, the amount they would pay, and things of that nature. What do we look for to lead around? The same thing we look for in any investment, right? Great founders, big markets, big trends, things that we think can grow to 100, 200, $300 million in annual revenue.
Is there, from Dan Goncharov, is there a minimum traction requirement for SaaS companies for your pre-seed fund?
No. There are exceptions to everything. I think of life investing in the classic Bell distribution curves. The fat part of that distribution curve has now skewed towards revenue. There are certainly cases where that doesn't need to be the case. We just did a company pre-revenue. Founder happens to be an ex-portfolio founder. that sold a business for 9 figures. So again, yes, but by and large, if you want to optimize to raise capital in this market, and this is what I tell our founders all the time, get to revenue if possible. Or if it's a product-led growth company, obviously it's a little different, show usage. If it's a long enterprise sales cycle with things like that, have pilots in flight, right? Have product in market, have a customer a VC can talk to that validates the pilot's working.
Also from Hugh Brown, I'll try to sum it up. How would an underrepresented founder break through if founders are being asked to do more with less and already have a hard time getting VC's attention? Just any advice for the underrepresented groups out there?
So I would say that a clear understanding, and this goes for any founder, of what needs to be true to raise capital for your business is really important. And this may not just be for underrepresented founders, but we'll take the example of selling into enterprise. If you sell into enterprise, it's a relationship sale because the person that's sitting in an enterprise, they're not paid, they're fairly risk averse. They're not paid to innovate, right? And if they're going to take a chance to put something new within their stack, they're usually going to do it for somebody that they know or they have experience with, particularly to be one of those early guinea pigs, if you will. And that's why it helps to have a network to sell into there. If you're doing more product-led growth, things like that, the product speaks for itself. You can kind of get it out there into market. In terms of underrepresented founders, that's something at Forum we track that very closely in terms of our fund rates. And while they're not where we want them to be as a fund, they're certainly amongst the best in the industry in terms of how we look at it. So I encourage any underrepresented founders to reach out to us. We are a very diverse team here across the 28 people that work here. We make a point of being very deliberate at a senior level. I even said it earlier in this call. I don't care about pedigree. Some of our biggest drivers of our founders have been from small towns in Scotland or female founders in Canada or founders in Tulsa. We want to see everything. We want to try to do a better job and lead the way from an industry perspective around funding.
I'm going to combine John Wallbank's and Ramon Alarcon's questions since they're basically the same thing. You're a SaaS fund. Do you invest in businesses that are not primarily SaaS or have a non-SaaS component to them, or SaaS is secondary, for example, hardware or a mobile game that uses specially developed AI?
We'll look at hardware-enabled SaaS. We've done some of that in the past. We've had success investing there. We'll look at marketplaces. We don't do consumer. So B2B is the biggest band. B2B SaaS is, again, the fat part of that curve, 85 to 90% of the portfolio. We do have some hardware-enabled SaaS. And the reason why some of that is less interesting is you layer in a hardware component that's like a separate business in and of itself, particularly if you're manufacturing it, right? I angel invested in a company that was doing smart helmets for motorcycles. And 3 weeks into COVID, he called me and said, "Hey, our factory's in Wuhan," right? Like these are just, it was hard enough to try to get business spun up, forget the NAND there. And then all of a sudden you run into stuff like that. And a lot of it comes down to margin profile too of these businesses. So especially now at the lens of what the public markets are valuing things at, we're conscious of what you hear unit economics, you hear all this stuff from VCs. We're very conscious of what a business will look like at scale from a margin perspective. And I would encourage all of you to look through a lot of these businesses that you know really well that have been funded over the past few years that are now in the public markets that have margins that are in like the 20 to 40% range, and just see where they trade and when the valuations are, and they don't look great. So there's a reason why the public market loves recurring cash flows. The market is predicated on growth and repeatability of cash flows and expect growth rates around them. A diversified basket of SaaS contracts within a company is very attractive to investors. And that's why we focus a lot of our time and energy there.
So we have time for one more. And if I didn't ask your question, please email myself or Ethan Stein, and we'll do our best to get them answered for you when we send out the packet within the next 48 hours. Just let us know, and we'll try to reconnect with James and get it answered for you. The last question will be from Hong Tai. I think this is a great question to end on. 90% of startups fail. Can you please provide suggestions on when you think a founder should stop pursuing their current effort?
Oh,
we'll end on a down note.
That's a great question, because you fund 100 companies a year. We get to know these founders really well. I won't say the name of the company, but there's a founder I've gotten really close with. We've probably talked once every week or two for the past 6 months through the journey of winding down the company. And he's done his best to get his investors their money back, and I really respect him for it. But part of my role is helping a founder, give them the confidence to walk away. But I also push founders when I don't think it's time. But I realize there's a huge opportunity cost for all the founders I work with. They're so talented. They can be doing so many great things, and we are only given, a certain amount of years here on earth. And it sometimes feels to these people that they don't want to waste a year on doing something. We had a portfolio founder who had raised a decent seed round. The business wasn't working, and an investor came to him and said, "I think you should give the money back and shut down the business." And while the delivery of it may not have been great for the founder, when we talked to them, we had an honest conversation, and we said, "What is your conviction level in this? You're supremely talented. You could be doing a lot of things. Do you want to spend the next year working against something that right now, if you were starting cold on, you'd say wouldn't work, and you have no indication it's going to? So how do you want to proceed?" And they ultimately decided to give the money back. I think the human level of startup founding is overlooked by many VCs, because it just sucks. I've been through it, like not being able to sleep at night, the stress of it, all of that. And I love the opportunity, and I spend time with founders when things aren't working to give them the confidence and the okay to kind of like fold the hand. And it's funny enough, usually the founders don't want to give up. You almost have to really help them get through that when it's not working, because we see so much. But it's a great question, because it's such an important part of this role to fund a founder and encourage them to do the impossible. I think we as investors owe them the support around how to ultimately like walk away and fold their cards if it's not working, to not leave them to make that decision on their own, because it is such a personal one, and there's so many people they feel accountable to, and they feel like they failed. And it's a big part of frankly what I like about this job, being able to help people in that capacity.
Great. Thank you so much, James. This was fantastic. We learned so much. I learned so much. We really appreciate you giving us an hour of your day. Like I said, to the people whose questions we didn't get to, sincerely apologize, but feel free to send them over to us, and we'll do our best to get them answered for you. On that note, thanks everyone in the audience, all 75 of you, for joining. It was a pleasure, and we'll have this webinar recorded and sent out to everyone within the next 48 hours. It's also going to be available on our YouTube channel, which will be linked in the email as well. Thank you so much. Enjoy the rest of your day, and we'll get you next time.
Michael, one more I just want to say, to start in the chat. Jeff asked around converting to a C Corp from an LLC. Yes, 100%. No institutional will fund an LLC. So if you're going to raise institutional capital, do that before you go after them.
There you go. Wise words to close it.
Bye, everyone. Thank you.
Thank you.